Most investors think momentum is just chasing what already went up. That's wrong. Momentum is one of the most persistent anomalies in financial market. It shows up across equities, commodities, currencies, and it has survived decades of research, crowding, and institutional capital. So instead of talking about it in theory, we are going to test it properly. We are building a real backtest using the actual constituents of the S&P 500. No survivorship bias, no shortcuts, no cherry-picked examples. We'll rank stocks based on their past returns, systematically construct portfolios in a live portfolio setting. Because the real question isn't, does momentum work? It's, does it still work when you implement it properly? Let's find out. Let's start with the core idea. Momentum is one of the simplest and most controversial ideas in finance. At a high level, it says assets that have gone up tend to keep going up. Assets that have gone down tend to keep going down. That sounds almost too simple, but it's not just a theory. It's backed by decades of empirical evidence. The framework we are following here comes from one classical paper. It's written by Jagadish and Titman. Their key finding is straightforward. If you systematically buy past winners and sell past losers, you generate persistent positive returns, especially over 3 to 12 months horizons. Not because you're taking more risk, not because of obvious factor exposure, but because prices don't fully adjust instantly. Momentum is built exactly on that key assumption. Markets don't react to information all at once. When new information enters the market, for example earnings, macro data, or sentiment shifts, prices move, but they don't fully incorporate that information immediately. Instead, the adjustment is gradual. That creates trend persistence. Momentum is partially behavioral and partially structural. Momentum is one of those few strategies that work across asset classes. It survives out of sample testing and still shows up decades after awareness. Which raises the real question, if everyone knows about it, why does it still exist? And that's exactly what we're going to test right now, because theory is one thing, but implementation is everything. We're going to build this strategy from scratch, and on the actual S&P 500 constituents, we will see if momentum really looks good in practice. We actually start by loading in our data. In one of our past videos, we explained on how you build your own financial database. So we loaded in pricing data for all S&P 500 constituents over time and plotted some of them here on the screen for you guys. Now let's jump into the theory behind calculating momentum and how to implement it in code. In this backtest, we're using what is known as 12-1 momentum. That means at any point in time, we measure a stock's performance over the past 12 months, but we skip the most recent month. Formally, the signal at time t is based on returns from t-12 a year ago to t-2, all the way to the month before our current month. Why is that? Why should we use that? This isn't arbitrary. It comes directly out of the academic literature. For example, the paper that we introduced earlier. Their results show something very specific. Momentum is strongest at intermediate horizons, roughly 3 to 12 months. It's not in the short term and not in the long term. It's right in that middle window. So the 12-month look back captures the full trend, but it avoids going too far back where the signal starts to decay. On the other hand, the short-term horizons, why you want to get rid of that 1 month most recent to you, is that in short windows, markets are not trading on momentum, they are more mean reverting. That means prices bounce back closer to the mean because of liquidity shocks, bid-ask effects, or short-term overreaction. So if you include the most recent month, you're mixing two completely different signals. One, the medium-term continuation that we want to look at here, and second, the short-term reversal, the mean reversion part that we don't want to include in our test here. And they cancel each other out. Skipping the last month just cleans up that signal. The nice part about momentum is you can literally implement it in 3 lines of code. Assuming we have our holdings, our start dates, and our prices loaded, we now can implement the momentum in Python. We want to look back for 12 months. We assume roughly 252 trading days here. We also implement our 1 month lag, where we assume that there's 21 trading days in a month. So we can now say our momentum 12.1 is the prices that we looked at. So let's open that up. Prices is just the data frame of prices. So we can say prices equals momentum 12.1 equals prices dot shift. So we shift them back to where? We shift them back to have our lag 1 month. And we want to divide that by prices dot shift. And we go back all the way to look back. To look back 12 months. And we subtract 1. So what this is basically doing, it is calculating the total return from a year ago to a month ago. And that's already almost everything we have to do here. All we now have to do is we rank our stocks based on that signal. So our momentum ranks is just momentum 12.1 dot rank. So what do we want to rank them on? We want to rank them on their cross-sectional performance. Method equals first, and we want it to be descending, meaning biggest is best. And we forgot a comma here. All we now have to do is our strategy. We have to tell our strategy which security to pick. I'm putting the top 50 stocks being in my long portfolio, the bottom 50 stocks in my short portfolio. If we look at the constituents, and you can see the code on how exactly to pick the stocks on screen right now. But if we look at which stocks are getting selected, in our long portfolio, we see securities like AppLovin, AVGO, Robinhood. On the other hand, in the short portfolio, we see securities like Moderna, Lululemon, and who else are we gonna look at? Probably that's the biggest 2 companies that are most known. So it is very interesting. In just 10 lines of code, we created our long and short portfolios. In the next step, we're gonna put those into the backtester and see if momentum still works. We can now take our signals over time and put them into the Code Capital backtesting engine. To do so, we create a top strategy and a bottom strategy. The top strategy uses the top 50 names that we just created. Very important here is that we only choose securities that are in the index at each point in time. And that's exactly that select where in portfolio line here. We don't want to introduce any biases by being able to trade securities that are not in the S&P 500. Same stands for the bottom strategy. So to summarize, our main strategy here is we select securities that are in the S&P 500, we filter them down for the top 50 performers in that index at that point in time, based on our momentum definition by looking 12 months back and calculating the total return minus the latest month. And we then equally weight all of those securities. We can run those backtests and look at the output. We can clearly see that the top momentum strategy heavily outperforms both the S&P 500 as well as the bottom top 50 strategy. So the bottom 50 strategy. We can look into the stats and see that our total return for the top strategy is 35% against 6% for the S&P 500. Similar on the Sharpe ratio, where our Sharpe ratio shows 2.8 for the top momentum strategy and 1.3 for the S&P 500. It is very important to note here though that we have a fairly short backtesting period, only starting in November of 2025. which could be a little biased towards the momentum strategy here. We can also look at the security weights over time, which also gets a little crowded and messy here as we trade as we have 50 securities in the security at each point in time, and we rebalance monthly. So there's a lot of, or there could potentially be a lot of turnover that you have to account for too. In the next step, we take this one step further and implement a class, or we use a class that is implemented in the Code and Capital strategy to give us even more insight into the strategy. The Code and Capital backtesting engine already comes with a predefined momentum signal that we can easily use. The nice thing here is that we can have way more statistics and breakdowns of the strategy using that momentum signal factor here. I already implemented it by creating a top algo and a bottom algo, and instead of using the pandas data frames that we created before, we can now easily use the momentum signal by passing in our look back of 12 months, and we use an offset of 1 month. We now switch the ranking algo a little bit in the sense that we, instead of choosing 15 names always, we select the top quantile or quintile in this example and the bottom quintile. On top of that, we create the same top 12 and bottom 12 strategies that we implemented before by drilling it down to securities that are actually in the portfolio. We add one additional thing. We now implement a long-short strategy where we long the top portfolio and we short the bottom portfolio. It's a very nice feature in the Code and Capital backtesting engine again. If we run the backtest or create our summaries here, we can now drill down into the signal a little bit more. First of all, it gives us the momentum signal, a little bit of a statistics, how the signal behaved over time. We can see the mean, median, and the 25th and 75th percentile of the signal that is created in the background. In this case, the total return over those 11-month windows. You can see that the total return spiked a little bit at the beginning of April, but it's normally centered at around 20 to 30% for the mean. We can also look at the data availability as we just use returns here and no fundamentals or anything more complicated. We obviously almost have the coverage of 100%. We can now look at the cumulative returns, which look very similar to what we've seen in the pandas implementation. The new one here is the top minus bottom strategy, our long-short strategy that longs the top 50 or the top quintile in this example, and it shorts the bottom quintile. We can see it fits right into the plot by going par to par with the top strategy. The nice thing is, by definition, a long-short strategy is market neutral. Next, we can look at some example stocks and see if they're in the portfolio. I just took 6-7 stocks here, 6-7 securities, and looked on or checked if they're in the portfolio. For example, Nvidia was selected in 93 of our portfolios. Google was in the portfolio at all time, whereas Microsoft was almost never in our portfolio. The top selected names we can look at again. We see like AVGO, for example. In the bottom, we once again see Lululemon here, as well as our Pool Corporation. This already shows you how easy it is to use the Code and Capital backtesting framework and test a strategy for yourself and see, does it have merit? Is it useful for me in a day-to-day basis? Should I scan this strategy and add it into my library of things that I want to trade or at least monitor? So here's the bottom line. Momentum works, not as a theory, not as a backtest trick, but as a persistent feature of how markets actually behave. Prices don't adjust instantly, investors don't react rationally, and capital doesn't move all at once. That gap between reality and expectation is where momentum lives. If you think in portfolios and not just signals, that's where it becomes very powerful. Follow Code and Capital for more signal breakdowns. See you in the next one.